Okay, in this chapter, chapter 12, we'll be looking at some lessons from capital market history. Remember that another name for the capital markets is the financial markets. In this chapter, we look at how to calculate the return on an investment. We will discuss the historical returns on various types of investments. We will also look at the risks on various important types of investments. And finally, we'll explain the implications of market efficiency. In other words, we will look at the theory or the hypothesis of market efficiency. Here is the chapter outline, and we'll begin by talking about returns. So here we're looking at risk return and the financial markets. And remember, the financial markets are also called the capital markets. So we can analyze the returns in the financial markets to help us determine the appropriate returns on non-financial assets as well. So let's look at some lessons from capital market history. The first lesson, and the one we always talk about in class, is that there is a reward for bearing risk. In other words, if you take on more risk, you expect a higher return. So you see here, the greater the potential reward or the greater the potential return, the greater the risk. So let's first examine dollar returns. Total dollar return is equal to the income from investment plus capital gain or loss due to the change in price. So if we look at an example from a bond, you notice that here you bought a bond for $950 1 year ago. You have received 2 coupon payments of $30 each, and you can sell the bond for $975 today. What is your total dollar return? Well, if you ask yourself, how much income did I receive? Then you would know that you received 2 coupon payments of $30 each, so that is $60. And the capital gain is the change in the price. So you bought the bond for $950 and you can sell it today for $975. It means that you made a gain of $25. The selling price, always the selling price, minus the purchase price. So your total dollar return would be your income of $60 plus your capital gain of $25 for a total of $85. Let's look at percentage returns. It's usually better and easier to understand when you look at percentage returns. So you see here, it is generally more intuitive to look at percentage returns rather than dollar returns. So for example, something we just did in chapter 8, the dividend yield is equal to your income over the beginning price, and your capital gains yield is equal to your ending price minus the beginning price over the beginning price. So your total percentage return, and you will remember that, like I said, from chapter 8, it's equal to the dividend yield plus your capital gains yield, which would give you a percentage return. So let's take a look at this example. You bought a stock for $35 and you received dividends of $1.25. The stock is now selling for $40. What is your dollar return? Well, you received a dividend of $1.25 plus your capital gain would be a change in the price, 40 minus 35, which is equal to $6.25. What is your percentage return? Well, if you calculate your dividend yield, and remember, your dividend yield is your dividend over the price. So you see here that is equal to $1.25 divided by 35. for 3.57%. Your capital gains yield would be equal to, as you just saw, your selling price minus your purchase price of $35 divided by 35, which is equal to 14.29%. So your total percentage return is 3.57 plus 14.29, which is equal to 17.86%. So let's talk a little bit about the importance of financial markets. Financial markets, put very simply, allow the flow of funds from those who have it to those who need it. In other words, from borrowers, from savers to borrowers. So you see here, financial markets allow companies, governments, and individuals to increase their utility. In other words, you have savers who provide the funds and borrowers who need the funds. So in other words, if a company wants to expand, the company would go to the financial markets to get funding in order to expand. So savers have the ability to invest in financial assets. In other words, savers have the ability to buy stocks, buy bonds, etc., so that they can defer consumption and earn a return to compensate them for doing so. So if you get paid today and you decide to save some of your money, then you expect a return, interest, for doing so. Borrowers, on the other hand, have better access to the capital that is available so that they can invest in productive assets, so that companies can expand, so that governments can take on projects, etc. So you see here as well, the financial markets provide us with information about the returns that are required for various levels of risk. And this is why the financial markets are very important. You get an idea from the markets of your return based on the level of risk that you are willing to assume. So the financial markets play a very, very, very important role in our economy. Let's take a look here, and you'll have a better view on your slides. You notice here we're looking at a dollar investment in different types of portfolios, and the data is from 1926 to 2016. And what you'll see here is that small company stocks, the green line, has essentially earned the highest return, followed by large company stocks. This looks like an orange line, followed by government bonds, right? And you see here that treasury bills would earn the lowest return because they are risk-free. And we'll talk some more about that in a bit. So small company stocks historically earn the highest return. Why? Because they are the riskiest. So if you want to take a closer look at the data, you could click on these Excel files to get a closer look at the data. Large company stocks, long-term government bonds, US Treasury bills, all that information is available. The actual raw data is available in these Excel files. So you could click on these to see more information on this data. But it's all summarized here for you, right? If you take a look at this, you see over the period 1926 to 2016, large company stocks have had an average return of 12%. Small company stocks, no surprise, have had a higher return, 16.6%. Long-term corporate bonds, 6.3%. Long-term government bonds, 6%. And as you would imagine, long-term corporate bonds have more risk than long-term government bonds, hence the higher return. Then you have US Treasury bills, 3.4%, and inflation averaging over the same time period of about 3%. Treasury bills 3.4, inflation 3%. So what is a risk premium, or what are risk premiums? This is very important. Remember, we said Treasury bills are risk-free. In other words, these are provided by the government. These are issued by the government. So there is no risk associated with Treasury bills. So when we talk about risk premium, the definition is that extra return that you earn for taking on risk. So if Treasury bills are considered to be risk-free, which means zero risk, the risk premium is any return over and above the risk-free rate. So it's that extra return above the risk-free rate that an investor gets for taking on additional risk. So let's take a look at the average annual returns and risk premiums. So the first thing I want you to look at is the average return for Treasury bills. Remember, these are considered risk-free, and the risk premium would be anything over the risk-free rate. So for large stocks, the average return was 12%. So the risk premium would be 12 minus 3.4%. Small stocks, the risk premium would be 16.6% minus 3.4%, which would be equal to 13.2%. For long-term corporate bonds, 6.3% minus 3.4%, and you see 2.9%, and so on. So anything over the risk-free rate is called your risk premium. And this shows you, this is, fun to look at. It's a frequency distribution of returns of just large company stocks from 1926 to 2016. And most of you have heard of the 2008 financial crisis. So if you look over here, you'll see 2008. And you'll notice that the returns are largely negative. 1931, during the Great Depression, you will notice very negative as well. When the economy was doing very well, right? You will notice here 2003, for example. You will notice very high and positive. Okay? So this is fun to look at. Take some time and look at this, and you will get a sense of which years resulted in very good performance for large company stocks.